It's Brian Preston, the money guy.
Let's transition to long-term care insurance.
I don't know if we did. Did we do this on purpose? Did you notice we kind of went through stages of life? Like we started at young with life insurance and disability, and now we're moving through, and now we're getting to long-term care. Did we do that on purpose?
No, it's better to be lucky than good.
That worked out really well.
So long-term care insurance. First of all, a lot of people, you're saying, wait, we talked about disability. What's the difference between disability and long-term care? Disability is when you're in the workforce and you're replacing income. Long-term care is when you need to bring in help to take care of you with your daily living. You know, the actual terminology is the activities of daily living. Sure. You know, as we get older, unfortunately, you start requiring more help for bathing, feeding, getting dressed, and those type of things. So that's the difference between disability. Disability is replacing income. Long-term care is getting somebody to come in and help you.
So I remember it was something like 1 in 2 young folks can expect to be disabled. Same thing true for long-term care?
Well, I think you can take some of those stats to know how long you need to get protection for, but it's, they're different. And the only here's the big stat I have is that only 8% of Americans have long-term care policies. Now, before we all panic and go, oh my goodness, why is America not covering this? Realize that this is one of those insurance industries that is trying to find its footing. I mean, it really is, because this is changing. It's all a big experiment in some way, because you have the baby boomers, this huge generation that's retiring. And insurance companies, they are profit motivated, right? But they also, they're having a hard time figuring out how this is going to work. So the policies, and what I mean by that is, just over the last decade, the average premium has gone from $1,000 to $3,000. So these policies have gotten much more expensive as the country is aging. The premiums are going up significantly, and I think you're also seeing. I mean, if we looked at this a decade ago, there were hundreds of long-term care providers. Now we're down to just a less than a dozen insurance companies are doing long-term care policies, because I think a lot of insurers have said, man, there's just too much risk here. With the graying of the country, we can't figure out how to make money off this product. So we're getting out of this. So it is, I'll give you that disclaimer on the front end, is that this is an insurance that is got a lot of changes just because of the graying of the population.
So I'm a young person, Brian, and I think that technology is going to continue to advance. So, folks in my generation are going to live to be, 120 years old. Should I go ahead and buy long-term care insurance now? Is now a good time for me to start shopping for it?
What you mentioned is definitely a problem. That's probably what these insurance companies are realizing too, is that this problem is getting extended since we're living longer. And as our bodies live longer, but our brains maybe won't live as well, there's all kind of exposure. But the answer to your question is, according to the American Association for Long-Term Care Insurance, the AALTCI, the best time to buy long-term care insurance is your mid-50s.
Okay.
That's what a lot of the research shows. And your mid-50s is when you probably want to look at this.
Any reason why you think mid-50s is the right time to start buying?
Well, I think it's one of those things. You're probably getting to the age where, you're focusing on this. You're thinking about, your mortality, your health. You've also, if you think about your life cycle of earning potential and other things, when you're paying, when you're young, you first start out, and this is a little bit of a sidebar, you start out, you come out of college, you don't have to pay for anything but yourself.
Right.
But then when you're in your late 20s, you start having kids and you have a mortgage. There's a lot of money being pulled out of your back pocket for life obligations. And then when you're in your 30s and 40s, you're worried about building financial independence. So that money's going there. It's probably about your 50s that you've moved up the financial planning pyramid to the point that you can say, okay, I think I've got these other goals figured out. Where do I fall now with covering making sure that, I don't deplete all my assets or, the legacy I want to leave to my kids. How do I make sure I don't lose all that money?
But if you waited till your 60s or 70s or 80s, it probably gets too expensive to be able to buy at that point,
because,
right?
They don't like things that they don't like. Now it doesn't mean you can't get coverage, but diabetes and other things like that will have an impact. Alzheimer's is a big risk with these things if they're worried about cognitive impairment. And that's why here's the ADLs, which is the activities of daily living. This is typically, you don't get benefits until you need help with at least 2 or 3 of these things. And they're bathing, which is typically the first thing that's going to become impossible to do when you're starting to have issues. Eating, dressing, using the toilet, walking, and then every policy, you need to make sure you understand what's the trigger point, what's the language used for cognitive impairment. That's dementia and, Alzheimer's and those type of things. Other components you need to understand with long-term care is elimination period. How long can you afford, paying for it out of your cash flow before?
So same thing as like disability.
Exactly.
3 months,
so,
6 months.
6 months, inflation protection. Here's the thing. You need inflation protection because the cost of long-term care facility treatments has gone up significantly. Sure. But the biggest increase that's going to occur to your premiums is if you choose an inflation rider, and you can do straight inflation or versus compounding interest inflation. And I always tell people, if you're trying to trim some money off, a planning opportunity you can do, especially if you're doing this in your 50s, so you're not too young. Maybe you just need to buy a bigger benefit on the front end and just put a simple inflation protection on there. Because when you do the compounding, it gets really expensive.
So I'm going to say that again. If you think that you need $2,500 today, instead of buying a $2,500 per month benefit with an inflation rider, maybe you buy a $3,500 a month benefit with no inflation rider.
Yeah, and without, we can't give individualized advice, but I'm just telling you some planning tactics that have been effective in the past. The other thing, benefit period. This is a big one because a lot of people want insurance to cover them for the rest of their life. Yeah. I mean, you want, what if you get Alzheimer's and you have to live in a facility for a decade?
Yeah.
I mean, that is a big fear. So a lot of times you want to get something that carries you for your life, but you're going to find out that it's so expensive. I mean, these policies get up to $6,000-$7,000 a year. Yeah. You might have to look at having a benefit period of only 5 years.
Sure.
I mean, that's the thing. And here's the other reason why I think that the adoption rate is only at 8%, is they can't raise the premium increases, can't focus on you, meaning they can't look at Bo Hansen and say, man, we sold that policy too cheap to Bo Hansen.
Right.
So we're going to, instead of his premium being $1,500 a year, next year we're going to charge him $4,000. They can't do that. They can't single you out. But here's the thing. They could look at the entire product line and they go, that product that we sold back in 2017, and a lot more people have Alzheimer's, or people are just living too long. They have the ability to raise the premiums on everybody that's in that group. They can't single you out, but they can raise it on everybody. So last thing, I want to close it out on long-term care to know if you need how to price this. Long-term care is one of those insurance products where we call it kind of a donut hole type of protection that you're trying to insure. If you're a person that's not wealthy, say you have less than 7 figures in all of your assets, there's a chance you could get into a situation where, while you're in a long-term situation where you needed help, your assets might be depleted completely, and then Medicaid is going to kick in. Okay. So, and really the reason you buy long-term care is to protect your wealth. Mm-hmm. If you're trying to leave something behind, or you want to make sure you have protection for taking care of you. Sure. So if you're a person who's not wealthy, you probably don't want to buy a long-term care because it's so expensive to buy this stuff. Sure. If you're wealthy, meaning you have a net worth probably over $3 million in assets, you very well could self-insure. So you're not going to be a great person to go out and buy this because you have enough assets that you'll just self-insure the risk that's out there. So that leaves the donut hole, that great big middle, which is everybody who's kind of between that $1 to $3 million. That's really the people that the long-term care market, and that's a very generalized way of looking at it. Okay, so it's at least giving you some guidelines.
If I find that I fall into that category, I'm in between, I'm in that big middle that you called it. What are some things that I should think about in terms of does long-term care make sense for me? I mean, do I think about like genetic stuff and family lineage? I mean, what are some things that I look at to determine if it makes sense for me?
I mean, I definitely think that stuff plays in it, but you also have to ask yourself, what's your mindset? We've had clients where they're just so fearful of not leaving behind this issue where their kids are going to have to take care of them. Mm-hmm. So they want to do long-term care. Or it's the other side of it. Maybe you have children that you look at them and you go, there's no way they're going to take care of me. So I better make sure that I insure away some of that risk. So I at least know I end up in a good place.
Sure.
Where I'm going to be taken care of. So those things, it's not only the medical stuff, it's also your psychological of what makes you happy, what's your desire, because this is not a super efficient market. I will tell you there's a lot of evolution and changes that are going on within the long-term care market. So it's not a slam dunk. And even if you fall in that great big middle of 1 to 3, you have to individualize and look at it and see if it makes sense for you. Because there's a lot of people, we have an insurance broker as a client. He doesn't own long-term care because he just thinks there's too much change. And he's worried that they would, too many variables to make it worthwhile.
Sure.